you own shares, ETFs, or managed funds and you've never actually told Centrelink about them directly, here's something you need to know. Curious. There's a very good chance Centrelink already has that information anyway, sitting quietly in your file, waiting to be matched against what you've declared. Welcome back to Centrelink Pension Bulletin. Today we're answering a question that comes up constantly in the comments section, and understandably so, because it affects your pension directly. Thoughtful. Can Centrelink actually see your investment accounts? And if they can, how exactly do they work out what those investments are worth and how much they count against your pension? By the end of this video, you'll understand exactly how this process works, how it's changed recently, and what you genuinely need to do to stay on the right side of the rules without any unnecessary stress. Let's start with the question everyone wants answered first. Can Centrelink see your share portfolio, your ETF holdings, or your managed fund investments, even if you haven't told them yourself? Yes, they can, and the way they do it might surprise you. Centrelink, through Services Australia, operates a formal data matching program with the Australian Taxation Office. Every time you receive a dividend from shares or a distribution from an ETF or managed fund, that payment is reported to the ATO, usually through annual tax statements issued by your broker or fund manager. Centrelink has access to that same information. On top of that, Centrelink also runs regular data matching checks with banks and financial institutions directly. This isn't a rare, occasional audit. It's an ongoing, routine process that happens continuously in the background, comparing what you've told Centrelink against what other government and financial systems are showing. Here's a question worth thinking about for a moment. If there's a gap between what you've declared and what Centrelink's data matching shows, how long do you think it typically takes before that gap gets noticed? For many pensioners, the honest answer is sooner than they expect. Now, here's an important distinction that trips a lot of people up, and it's worth getting really clear on. Reporting your investments to Centrelink isn't optional, even if you assume they'll find out anyway through data matching. You are required by law to declare your financial assets when you first apply for the pension and to update Centrelink whenever there's a significant change. Relying on Centrelink to catch a discrepancy through data matching rather than reporting it yourself isn't a safe strategy. If Centrelink identifies an inconsistency, it can lead to a formal review, a recalculation of your pension going backwards, and in some cases a debt notice for pension you weren't actually entitled to receive. So let's move on to something equally important. Once Centrelink knows about your investments, whether through your own reporting or through data matching, how exactly do they work out how much those investments count against you? This is where a lot of confusion happens because Centrelink doesn't just use one calculation, it uses two at the same time, and understanding both is genuinely the key to knowing where you stand. The first is the assets test. This one is fairly intuitive. Centrelink adds up the current market value of everything you own that counts as an assessable asset. That includes your shares, ETFs, managed funds, savings accounts, term deposits, your car, and household contents. Your family home is excluded entirely regardless of its value, which is worth remembering if you've owned your home for a long time. Here's the detail that catches so many investors off guard. Centrelink values your shares and ETFs at their current market price, not what you originally paid for them. So if you bought shares years ago for a modest amount and they've grown significantly since, that current higher value is what counts, whether you've sold a single share or not. As things currently stand, a single homeowner can hold assets up to a certain threshold and still receive the full pension, with that figure gradually reducing as assets increase until the pension phases out entirely at a higher combined threshold. For couples who own their home, both of these thresholds are naturally higher, reflecting the combined nature of their assessment. These figures are reviewed and adjusted twice a year in March and September, so what applied last year isn't necessarily what applies today. Now, here's the second calculation, and this one is where most of the genuine confusion comes from. Alongside the assets test, Centrelink also applies something called Deeming under the income test. Deeming assumes your financial assets, including your shares, ETFs, and managed funds, are earning a set rate of return, regardless of what they're actually earning you in real dividends or distributions. This might sound unfair at first, but understanding why it exists actually makes it much easier to accept. Deeming exists because tracking the exact real-time earnings of every pensioner's investment portfolio, updated constantly, simply isn't practical. So instead, Centrelink applies a standard assumed rate and adjusts it periodically to reflect broader interest rate conditions. Here's what makes this year particularly significant. Deeming rates had been frozen at historically low levels since 2020, largely to support retirees through a period of very low interest rates. That freeze officially ended in mid-2025, and updated rates recommended by the Australian government actuary took effect from the 20th of March this year. For pensioners holding substantial share portfolios or managed fund investments, this change has had a genuinely noticeable impact. If you haven't reviewed your Centrelink assessment since that date, it's well worth doing so now because your payment may have shifted without you fully understanding why. Let's walk through a practical example because seeing the numbers laid out makes this far easier to follow. Imagine you're single and your total shares, ETFs, and managed fund holdings combined with some savings add up to $400,000. Centrelink applies a lower deeming rate to the first portion of that amount up to a set threshold and a higher deeming rate to everything above it. The combined deemed income from both portions is then treated as your income for pension calculation purposes, regardless of what your investments actually paid you in real distributions that quarter. Here's the part that genuinely surprises people the first time they understand it fully. If your real investment earnings happen to be lower than what Centrelink deems, there's no adjustment in your favor. The deemed figure still applies. But if your real earnings are higher than the deemed rate, that extra amount isn't counted against you at all. It's one of the few areas of the pension system where strong investment performance can actually work quietly to your advantage. Now let's talk about the specific types of accounts and structures, because this is a detail that often gets overlooked and it genuinely matters depending on how your investments are set up. If you hold shares or ETFs individually in your own name, the full value is assessed against you. If you hold investments jointly with a spouse or partner, the value is generally split evenly between you both for assessment purposes, regardless of who originally contributed the funds. And if your investments are held within a self-managed superannuation fund, once you've reached pension age, they're generally assessed in essentially the same way as investments held outside super, whether the fund is in accumulation phase or already paying you a pension income. This last point catches a surprising number of new retirees off guard. There's a common assumption that superannuation is somehow separate or invisible to Centrelink once you've retired. Once you've reached pension age, that's simply no longer the case. Whether your super is sitting in an ETF-based investment option or a traditional managed fund within your super account, it's counted, and deeming applies to it in the same way as any other financial asset. Let's pause here for a genuinely useful question. If you hold investments across multiple platforms, perhaps some shares directly through a broker, an ETF portfolio through an investment app, and a managed fund through your superannuation, have you actually added up the combined total recently? Because Centrelink assesses the whole picture together, not each account in isolation. Now, let's talk about what you should actually be doing with all of this information, because understanding the rules is only useful if it translates into practical action. The first step is straightforward. Review the current market value of your shares, ETFs, and managed funds regularly, ideally every few months, and especially after the March and September threshold updates each year. Most investment platforms and broker apps make this easy to check with just a few taps. The second step is keeping Centrelink updated whenever there's a meaningful change in that value, rather than waiting for an annual review or worse, waiting for a data matching discrepancy to surface the issue for you. This can generally be done quickly and easily through your MyGov account linked to Centrelink.
The third step, and this one is often underused, is taking advantage of Centrelink's free financial information service. This service can walk you through exactly how your specific investment mix is being assessed and help you understand the real impact of any changes you're considering, whether that's restructuring your portfolio, consolidating accounts, or simply understanding your current position more clearly. Let's bring this all together now, because there's a lot to take in and it's worth summarizing clearly. Yes, Centrelink can see your shares, ETFs, and managed fund investments through both mandatory self-reporting and ongoing data matching with the ATO and financial institutions. These investments are assessed under two systems simultaneously: the assets test, based on current market value, and the income test, using deeming rates that increased significantly this year after being frozen since 2020. How your investments are structured, individually, jointly, or within superannuation, can affect exactly how they're assessed, and staying on top of regular updates to Centrelink is genuinely the safest, simplest way to avoid unexpected surprises. None of this means investing is something to be wary of as a pensioner. Quite the opposite. Understanding exactly how these rules work simply means you can make informed decisions, structure your finances sensibly, and know precisely what to expect from your pension payment, rather than being caught off guard down the track. If this video helped clear up something you've been wondering about, please give it a thumbs up. It genuinely helps more retirees discover clear, honest guidance on a topic that affects so many of us. And if you haven't already, please subscribe to Centrelink Pension Bulletin, because we bring you these detailed updates in plain, simple language, exactly as the rules change throughout the year. I'd love to hear from you in the comments below. Have you noticed a change in your pension since the deeming rates increased earlier this year? Or do you have a specific question about how a particular type of investment is being assessed? Let me know, and it might just become the topic of a future video. Speaking of future videos, next time we're going to look closely at the work bonus and how working retirees can earn additional income without it reducing their pension, including some recent changes that make this more generous than many people realize. I do hope you'll join me for that one too. Thank you so much for watching, and I'll see you in the next video.